Let me walk you through something that has genuinely been keeping me awake at night. Silver has just touched 86.62 per ounce. That is an all-time high. This is a price level that has never existed in modern market history. And when you examine the structure of this market, when you understand how futures exchanges actually function, and when you look closely at what happened just 3 weeks ago, when the CME increased margin requirements by 15%, it becomes clear why we are approaching the most dangerous phase the precious metals market has seen since 1980. Based on historical exchange behavior, regulatory patterns, and the stress signals already visible inside the banking system, there exists a critical price zone, somewhere between a 90 and a 100, where the Chicago Mercantile Exchange will be forced to make a decision: either allow the market to continue higher and risk a systemic failure, or halt trading entirely to protect the clearing system. Today, Sunday, January 12th, 2026, I'm going to explain exactly what could unfold if silver breaks 95s. I'll walk you through the mechanism using actual exchange rules, show you precedent from other commodity markets, and explain why, even if the CME halts trading, Shanghai premiums and physical market dynamics make this situation fundamentally different from any prior intervention. This is not a claim that silver will do this tomorrow. This is not a prediction. This is a breakdown of the playbook, what history, rules, and structure suggest happens if the rally continues. Let me show you what may be coming. Before we go any further, it's critical to understand what took place in late December and early January. The CME group, which operates COMEX, where silver futures trade, raised margin requirements 3 separate times in just 4 weeks. On December 20th, initial margin for speculative silver contracts was raised from $24,000 per contract to $29,500. On December 30th, it was raised again to $32,000. Then, on January 6th, just 6 days ago, margins were increased once more to $35,750 per 5,000-ounce contract. That represents a 49% increase in margin requirements in less than 3 weeks. Why did this happen? Officially, the justification is risk management. When volatility rises, exchanges increase margins to ensure traders can cover potential losses. That is standard procedure, but timing matters. Silver was trading at $71 on December 20th. Today, it is $86. Each time price broke through a major resistance level, margins were raised. After every hike, price dipped temporarily as leveraged traders were forced to liquidate. Then the rally resumed. This is not speculation or conspiracy. The CME publicly publishes all margin changes. Every number I've cited is verifiable. And the pattern reveals something important. The exchange is attempting to slow the rally by making long positions more expensive. They are applying pressure through margins, but the pressure isn't working. Silver keeps moving higher. So what comes next in the exchange's toolkit? Based on rulebooks and historical precedent, the next step is a trading halt. Before continuing, a brief note for viewers who want to go beyond surface-level headlines. I've created a short educational guide called the Silver Insider Toolkit. It explains the structural warning signs that emerge inside the physical silver market before major repricing events, things like COMEX inventory shifts, futures curve behavior, delivery stress, and government policy changes. This is the same analytical framework I use. You'll find the link in the description. Now let me be absolutely clear about what I am and am not saying. I'm not claiming the CME will halt silver trading tomorrow. I'm not claiming access to insider information. What I am doing is analyzing the regulatory framework, historical exchange behavior under stress, and current market structure to show what becomes possible if this rally continues. Under its rulebook, the CME has emergency authority to halt trading if price movements threaten the financial integrity of clearing members. This authority is explicitly stated in Chapter 4, Rule 432 of the CME Group Rulebook. It is public. Anyone can read it. This rule grants the exchange broad discretion to impose trading halts or cooling off periods if volatility poses a risk to the clearing system. How do they determine that risk? They examine mark-to-market losses, margin adequacy, and whether clearing members, banks and brokers that guarantee all trades, can absorb potential losses. When losses reach a level deemed intolerable, the exchange intervenes. So the real question is not whether the CME has the authority to halt trading. It does. The real question is, at what price level do losses become unacceptable? Now, let's look at the math. The CFTC's weekly Commitments of Traders report shows position data across trader categories. In the most recent report, covering the week ending January 7th, the producer, merchant, pulled processor, user category, which includes bullion banks, held net short positions of approximately 289 million ounces of silver. Not all of these shorts are speculative. Many are legitimate hedges. Mining companies hedge future production. Industrial users hedge costs. However, independent analysts estimate that 100 to 150 million ounces represent unhedged speculative or market-making positions by bullion banks. Using 125 million ounces as a reasonable midpoint, we can run the numbers. Assume those shorts were initiated at an average price of $65, which is reasonable given silver's rally from $50 to $70 over the past year. At today's price of $86, the loss is $21 per ounce. Multiply that by 125 million ounces, and you get 2.625 billion in unrealized losses. That level is manageable. JP Morgan alone holds roughly $250 billion in Tier 1 capital. A $2.6 billion loss is painful, but not catastrophic. But what happens at $95? Losses increase to $30 per ounce, totaling $3.75 billion. Still survivable. At 105, losses hit $40 per ounce, or $5 billion. At 120, losses reach $55 per ounce, totaling $6,875 billion. Now, the pressure becomes real. And here's the critical twist. Those estimates assume the short position remains at 125 million ounces. COT data suggests that as price has risen, commercial shorts have added to their positions in an attempt to cap price. If the real unhedged short exposure is closer to 250 million ounces, then at $95, losses jump to $7.5 billion. At 105, losses reach $10 billion. At 120, they explode to $13.75 billion. If these positions are concentrated among a small number of banks, a single institution could face existential losses. That is the risk the CME is monitoring in real time. They are watching positions. They are watching mark-to-market exposure. And at some point, if a clearing member approaches insolvency or cannot meet margin calls, the exchange must act. Based on the recent margin hike pattern, 3 increases aimed at slowing the rally, and based on the precedent I am about to show you, I estimate the trading halt pain threshold lies between $95 and $110, not $127. As I ISV stated in prior hypothetical scenarios grounded in real exposure data and real bank capital levels, systemic risk emerges in the $95 or $110 range. And silver is currently trading at $86. That places us just $9,000 to 24 away from the danger zone. Now let's look at precedent, because this is not theoretical. On March 8, 2022, the London Metal Exchange halted trading in nickel. While silver primarily trades on COMEX rather than the LME, the mechanism is identical. Exchanges operate with the same emergency powers. Nickel was trading near $25,000 per metric ton when a massive short squeeze erupted, driven largely by Tsingshan Holding Group, which held enormous short positions. Prices surged from $29,000 to $48,000, then exploded above $100,000 in under 2 days. Tsingshan faced nearly $10 billion in losses and could not meet margin calls. JP Morgan, one of its prime brokers, was exposed. A default would have imposed massive losses on the bank. In response, the LME halted trading for 8 days. When trading resumed, they canceled all trades above $50,000, retroactively voiding transactions to protect short positions. This was unprecedented. The exchange literally rewound the tape, erasing profits from traders who had correctly positioned for the squeeze. Now, the LME operates under a different regulatory framework than the CME. The CME is regulated by the CFTC and operates under U.S. law. The probability of the CME canceling trades the way the LME did is significantly lower because of legal liability. However, the halt mechanism itself is identical. If the CME concludes that ongoing trading poses a threat to the clearing system, it has the authority to halt the market. It has exercised this power before. It did so briefly in crude oil in April 2020 when prices turned negative. It also did so in equity index futures during the 2010 flash crash. The authority is real. The precedent exists. The only unknown variable is the trigger price level. Now, this is where the situation becomes especially interesting, and this part is grounded in observable real-world data. Silver does not trade in a single location. It trades across multiple global venues. It trades on COMEX in New York. It trades on the Shanghai Futures Exchange. It trades in the over-the-counter spot markets in London and Zurich. And at the moment, there's a price divergence between these markets. As of Friday's close, spot silver on COMEX was trading at $85.67. On the Shanghai Futures Exchange, the most active contract settled near $88.70. That represents a $3 premium, meaning Shanghai is pricing silver $3 higher than New York. At first glance, $3 may not sound meaningful, but historically, it is extremely important. Normally, Shanghai trades at a modest premium, perhaps 50 cents to 1, reflecting import costs and local demand. A $3 premium signals physical tightness inside China. It means industrial buyers are bidding aggressively, and that premium effectively establishes a floor under the global silver price. Here's why that matters. If COMEX silver drops to $80 while Shanghai remains at $88, arbitrage traders can buy silver on COMEX, take delivery, ship the metal to China, sell it at $88, and lock in an 8 per ounce risk-free profit. This arbitrage flow drains COMEX inventories. As long as the Shanghai premium remains elevated, any meaningful dip in COMEX prices is immediately bought by arbitrage traders. In this way, Shanghai acts as a shield. It prevents the paper price in New York from collapsing below the physical price in China. And if the CME were to halt trading, Shanghai would continue trading uninterrupted. Global price discovery would shift east. When COMEX eventually reopened, it would be forced to reopen near Shanghai's price, or risk an immediate and catastrophic inventory drain. This is the trap. The CME can halt COMEX trading, but it cannot halt Shanghai. And as long as Shanghai trades at a premium, halting COMEX does not stop the price from rising. It merely relocates price discovery. Now, let me prove that this flow is already underway using vault data. COMEX publishes daily warehouse reports. As of Friday, January 10th, registered silver inventories, the metal available for immediate delivery, stood at 123 million ounces. Just 6 weeks earlier, on November 28th, registered inventories were 168 million ounces. That is a 45 million ounce decline in 6 weeks, or roughly 7.5 million ounces per week, leaving the COMEX system. Where's that silver going? Some is going to industrial users. Some is moving into private hands. And critically, a portion is being taken by arbitrage traders and shipped to Shanghai to capture the premium. This outflow is fully documented in public data. Anyone can verify it. More importantly, the pace is accelerating. In November, weekly declines averaged 4 million ounces. In December, that increased to 6 million. In early January, the rate has jumped to 8 to 9 million ounces per week. This drawdown is exponential. At the current pace, registered inventory reaches zero by mid-March. Yes, the CME also reports eligible inventory, which currently stands at 347 million ounces. But eligible silver is not available for immediate delivery. If you are short a February contract and required to deliver, eligible metal does not count. You need registered metal. That is why the registered category is the critical metric, and it is flashing red. This data tells us that physical demand, industrial demand, and arbitrage demand are overwhelming paper supply. And when physical overwhelms paper, exchanges lose control. Before continuing, I want to ask you to do something. If this analysis is helpful, if understanding exchange, halt mechanics, and the Shanghai Shield improves your decision-making, subscribe to this channel. Turn on notifications. What I'm doing here is different from most silver commentary. I'm not hyping silver. I'm explaining regulatory mechanisms, exchange rules, historical precedents, and real data. I'm giving you tools, not promises. I'm not claiming insider access. I'm not inventing events. I'm analyzing public information honestly. If that matters to you, support this work. Now let's continue. Let me walk you through a hypothetical scenario, not a prediction, based entirely on precedent. Suppose it's Monday morning, January 20th. Silver closed Friday at $94. Over the weekend, geopolitical tensions escalate. When Asian markets open Sunday evening, silver gaps to $97 in the first hour of trading. The CME clearing department runs stress tests and discovers that 3 of its largest clearing members are facing margin calls exceeding their immediate liquidity buffers. At 6 a.m. New York time, before the COMEX session opens, the CME releases a statement. Due to extraordinary volatility in silver futures markets and pursuant to CME Rule 432, trading in silver futures will be halted for a 24-hour cooling-off period to allow market participants to assess conditions. Trading will resume Tuesday morning with adjusted margin requirements. What does this mean for traders? If you are long silver futures, your position is frozen. You cannot exit. You cannot take profits. You're locked in at $97. If you're short, you receive a lifeline, 24 hours to raise capital, negotiate with brokers, or attempt to hedge. The halt is framed as market protection, but in reality, it protects the shorts. Now here's the twist. While COMEX is halted, Shanghai continues trading. On Monday night in China, the Shanghai Futures Exchange opens as usual. Chinese traders see that COMEX halted at $97 and interpret it as extreme bullishness. The Americans had to stop trading because shorts were under stress. Shanghai opens at $90. By Tuesday morning, Shanghai is trading at $102. Now the CME has a problem. If they reopen COMEX at $97, arbitrage traders immediately buy COMEX and sell Shanghai, locking in instant profits. The vaults would be drained in hours, so the CME is forced to reopen near the Shanghai price. COMEX reopens Tuesday morning at $101, not $97. Shorts who believe the halt would save them now face a higher price than before. But there's a second twist. When trading resumes, the CME announces new margin requirements. Instead of $35,750 per contract, margins are raised to $60,000, a 68% increase. Every long trader must immediately post significantly more capital. Most retail traders cannot do this. They are forced to liquidate. Institutions can post the margin. Retail traders cannot. Forced selling hits the open. Price drops from $101 to $94 in the first hour. Headlines read, "Silver crashes after trading halt." But notice something important. $94 is still higher than where trading was halted. The halt and margin hike didn't stop the rally. They simply created volatility and flushed out weak hands. Now consider the alternative scenario where the CME chooses not to halt. Eventually, margins become so high that only the largest institutions can participate. Retail traders are priced out, volume collapses, liquidity evaporates, and when liquidity disappears, volatility explodes, gaps, flash crashes, and violent recoveries. At that point, the CME could invoke force majeure, not a halt, force majeure. This is a declaration that delivery obligations cannot be fulfilled due to circumstances beyond control. If registered inventory falls to 10 million ounces, but 50 million ounces are standing for delivery, physical delivery becomes impossible. Contracts are cash settled at a forced price. This has never occurred in COMEX silver, but it did happen in palladium on NYMEX in 2001. It could happen in silver if shortages intensify. Based on current inventory trends, critical levels could be reached by March or April. Now zoom out. Why is this happening? Why is silver at all-time highs? Why are inventories draining? The answer is fundamentals, real documented fundamentals. In 2025, silver was the best performing precious metal, rising 170%. This rally is driven by three forces. First, supply deficit. Global mine production was approximately 800 million ounces. Global demand was roughly 1 billion ounces, a 200 million ounce deficit filled by recycling and inventory drawdowns. Second, exploding industrial demand. Solar panels consumed 140 million ounces in 2025, up from 100 million in 2023. EVs consumed 65 million ounces, up from 40 million. Industrial demand is rising faster than mine supply. Third, investment demand. Inflation concerns and geopolitical risks pushed ETF inflows, coin sales, and bar demand to record levels in 2025. These forces are not temporary. Solar and EV production is accelerating. Mine supply cannot respond quickly. It takes 7 to 10 years to develop a new mine. The structural shortage is real. This is not hype, it's arithmetic. So when I discuss trading halts or force majeure, I am not fear-mongering. I'm explaining how exchanges react when physical markets overwhelm paper markets. When too many traders stand for delivery and metal is unavailable, the exchange faces a crisis. This is exactly what happened in nickel. Jingshan was short, delivery was impossible. The exchange halted trading to prevent default. Silver could follow the same path if registered inventories continued to drain. Am I saying this happens next week? No. I am saying it is possible if current trends persist. And you need to understand the mechanism. If you wake up one day to a headline reading CME halts silver trading, you need to understand what it means and how to respond. If you own physical silver, a CME halt does not freeze your metal. You still own it. A paper sell-off may cause temporary price volatility, but Shanghai premiums, physical demand, and structural shortages remain intact. A halt signals paper stress, not physical weakness. If you hold silver futures, a halt is far riskier. Your position freezes, margins rise, forced liquidation becomes likely. This is why experienced traders often prefer physical or fully funded positions during extreme volatility. Leverage magnifies gains, but also regulatory risk. The nickel halt proved that exchanges can change the rules mid-game. The December margin hikes proved it again. Now, let me show you what typically happens to the Shanghai premium after a hypothetical CME halt. Right now, Shanghai trades $3 above COMEX. If COMEX halts, historical evidence from other commodities suggests that premium expands. During the nickel trading halt, prices in Shanghai continued rising even while the LME was shut down. The reason was simple. Chinese buyers still needed nickel to keep factories running, regardless of what was happening in London. The same dynamic applies to silver. Chinese solar panel manufacturers, EV battery producers, and electronics companies require silver to operate. Their demand does not stop just because COMEX halts trading. They continue purchasing metal through the Shanghai market. As a result, the Shanghai price keeps climbing even if Western paper markets are frozen. Imagine COMEX halts silver trading at $97. Over the following 3 days, Shanghai continues trading and rises to $185. The premium expands from 3 to 8. When COMEX attempts to reopen, if it tries to resume trading at $97, an $8 arbitrage gap immediately exists. That represents roughly a 27% instant profit for anyone able to buy silver on COMEX and ship it to China. That arbitrage pressure forces COMEX to reopen near $105. In other words, the halt does not cap the price. It merely delays price discovery by a few days and transfers control to Shanghai. This is precisely why the Shanghai Shield matters so much. As long as physical demand in China remains strong, any paper intervention in Western markets has limited power. The physical market is now dictating terms to the paper market. This is a historic shift. For decades, New York and London set prices and the rest of the world followed. Now, Shanghai is establishing the floor, and New York is reacting to it. That is the new reality. Let me now walk you through a potential timeline for the next 4 to 8 weeks. This is not a forecast. It is scenario analysis based on existing data. At present, silver is trading near $86, an all-time high. If the rally continues, the next levels are $90, then $95. At 95, the CME is likely to raise margin requirements again, potentially the fourth increase in 5 weeks. That margin hike would likely cause a short-term pullback, perhaps to $82 or $90. However, that dip would almost certainly be bought aggressively by physical buyers and arbitrage traders. From there, the rally resumes and pushes toward $100. At that point, the CME faces a serious decision. It can either raise margins dramatically to $70,000 or $80,000 per contract, or halt trading for a cooling off period. If margins are raised, liquidity deteriorates. Retail traders are forced out. Volatility increases sharply. If trading is halted, Shanghai continues trading, the premium widens, and when COMEX reopens, prices are higher than where they halted. In either case, the upward trend remains intact. By February, prices in the $110 to $120 range would not be surprising. By March, if registered inventories continue declining at the current pace, the market faces a real risk of a delivery crisis. At that stage, force majeure becomes a legitimate possibility. None of this is guaranteed. This is scenario planning. But given the trajectory of the data, the persistent supply deficit, and the exchange behavior already observed, this is the path we are on unless something materially changes. So what should you do? First, if you are considering exposure to silver, understand both the risks and the opportunities. Physical silver offers the strongest protection from exchange rule changes and counterparty risk. You own the metal outright. The trade-off is higher premiums. American Silver Eagles are currently selling at 30 to 35% above spot. But if silver is moving toward $120, paying a premium at $86 may still be cheaper than buying later at much higher prices. Futures contracts provide leverage and liquidity. You can enter and exit positions easily, but you face margin risk, regulatory risk, and counterparty risk. The exchange can change the rules at any time. If you use futures, avoid excessive leverage and maintain cash reserves to handle sudden margin increases. ETFs, such as SLV or PSLV, offer exposure without the storage challenges of physical metal. However, ETFs have their own vulnerabilities. In a severe shortage, new share creation can be suspended if metal cannot be sourced. PSLV is generally safer than SLV because it holds allocated metal in Canada, but even PSLV can face supply constraints during extreme tightness. Mining stocks offer leveraged upside. If silver reaches $120, miners producing at $30 per ounce generate substantial profits. However, mining stocks come with operational, political, and management risks. They are businesses, not pure silver proxies. A diversified approach, combining physical metal, carefully managed futures, ETFs, and select mining equities, is likely the most balanced strategy for silver exposure. To conclude, we are at a critical moment in the silver market. All-time highs, a structural supply deficit, rapid inventory depletion, a persistent Shanghai premium, repeated margin hikes by the exchange. Every one of these signals is real and verifiable. Based on this data and historical precedent from other commodity markets, there is a meaningful probability that the CME could halt silver trading if prices move into the $95 to $110 range, and clearing members come under stress. This is not a conspiracy. It is standard exchange behavior under extreme conditions. The nickel halt proved that. If a halt occurs, volatility will increase. There will be pullbacks. Weak hands will be shaken out. But the underlying fundamentals, supply deficits, industrial demand, and physical buying from Asia, do not disappear. A halt would be a temporary disruption, not a reversal. In fact, a trading halt would be the strongest confirmation imaginable that the physical shortage has overwhelmed the paper system. It would mean physical demand has won. So if you see headlines about a CME silver trading halt, do not panic. Understand what it represents, recognize it as evidence that the system is straining under real-world constraints, and position yourself accordingly. Silver is at $86, an all-time high. The next levels are $90, $95, and $100. What happens at each step is uncertain, but the direction remains higher until the supply deficit is resolved, and that deficit is not resolving anytime soon. Position thoughtfully, understand the mechanics, respect the risks, Prepare for volatility because the next 48 weeks are shaping up to be historic. If you want the institutional framework behind today's analysis, the Silver Insider Toolkit is linked below. It's purely educational and shows how to read the silver market beyond the price chart.